In this video, we're going to work through issuing a bond with a discount. Number one on the Chapter 14 bond discount worksheet. So, number one, BOCO Incorporated issues bonds with the following provisions. Got a $1,000 par. Issue price is 96% of par value. Stated interest rate is 6%. Market's 8%. Pays interest twice a year. And it's a 2-year bond. Okay? So let's work through it one thing at a time. So what are we going to do on December 31st when we record the bond issue? What are we going to do here? Well, first thing is we're only going to get 96% of par value. Why is that? Because interest rates have gone up since we decided to issue the bond. We had issued a 6% bond. This is an 8% bond. Rates have gone up, so the value of the bond has gone down. So the par value of the bond is $1,000. We're going to get 96% of that from an investor, so that's $960. And the $40 is what we call the discount. We sold it for less than par value, so we sold it at a discount. No different than buying stuff on the President's Day sale and getting it on sale. All right, so what's going to happen when we issue the bond? Well, we're going to get cash, I think. 96% of $1,000 is $960. That's a debit, right? We're going to have a bond payable. That's the par value of $1,000. And it looks like we need a $40 debit to make it balance, and that debit's going to be to the discount on bond payable. Okay, so that's the entry. Now let's do that down here while we're working on it. We issue the bond of a bond payable of $1,000, of a discount debit of $40, and we'll get $960 in cash. So here is our entry. Payable $1,000, discount $40, cash $40. That matches up with that. Okay, what's going to happen? Well, June 30th is going to come and we're going to pay some interest. How much are you going to get? The market rate's 8%. However, what's printed on the bond is 6%. 6% of a $1,000 bond. 6% times $1,000 equals $60, right? But we pay interest, and that's $60 per year. We don't get it. We're not paying interest every year. We're paying it twice a year. So if you want $60 a year, I'm going to give you $30 in cash right now. So I'm going to write a check for $30, credit cash. What else do I have to do? Well, look at this right here. This is the carrying value of the bond right now. $1,000 minus $40, $960. Well, when we pay this bond off, we're not going to pay off $960. We're going to give you back the $1,000 that's printed on the bond. So this discount has to disappear over the life of the bond. Now, that discount represented money that you didn't give me. You gave me $40 less than I wanted for that bond. So that $40 is an additional expense to the business. So what do I have to do? I have to convert that discount into an expense over the life of the bond. And we do it each and every time we pay an interest check. So we're going to amortize our discount of $40 over the life of the bond, which is 2 years, 2 payments a year. We're going to do that over 4 payments. So we're going to amortize $10 per payment. So let's do that. So it's a debit, so to get rid of it, I need to credit it, right? So I'm going to credit discount oops, for $30. Not for 30, for $10 rather. And what's our total interest expense? $30 in cash plus $10 from the discount gives us total interest expense of $40. Let's do that in our T accounts. So I'm going to pay you $30 cash. There's my check for $30. I'm going to amortize $10 of the discount. Credit a 10, credit a 30. What do I need to do? 10 and 30 is $40 interest expense. That's June 30th, right? This is June 30th. Okay. What's the next thing that happens? December 31st. What's going to happen December 31st? Well, I'm going to send you another check for $30. The accounting department is going to amortize another $10 of that discount, and I'm going to record another $40 in interest expense. First year's done, isn't it? It's now June 30th of the following year. What's going to happen? I'm going to send you your check for $30 again. The accounting department is going to amortize another $10 worth of discount, and we're going to recognize the total of that, $40, as interest expense. Last but not least, it's now December 31st of year 2. What am I going to do? You're going to get another check for $30, I think. The accountant's going to amortize another $10 worth of discount, and we'll recognize another $40 worth of interest expense. Well, now it's now December 31st, 2 years from now. We have to do one more thing. We have to pay our bond off, don't we? So I'm going to send you a check for $1,000. I'm going to credit cash for that check. I'm going to get debit bond payable for $1,000. Bond is gone. Discount, how much? 0. Bond is now 0. Bond's gone. Look what happened when we amortized our discount. It started at 40, then went to 30, 20, 10, 0. This next thing here is called an amortization schedule. First, let me record that bond maturity. I debited bond payable for $1,000, and I credited cash for $1,000. That reflects this. I don't know why I put it below the amortization. Who knows? Well, this is an amortization table. This is going to show us what happens to this bond over its useful life. So let's take a look. So this is when we issue the bond, right? What happened at that point? We had a bond payable of $1,000, and we had an unamortized discount of $40. Okay, discount of 40, bond of $1,000. What was our carrying value? $960. Let's move on. What did we do next? We paid some interest expense. So I gave you a check for $30. The accountant amortized $10 worth of discount, which made our interest expense $40, right? 10 plus 30 gave me 40 in interest expense. We have now amortized $10 worth of our discount, which leaves us 30 left to go, and our carrying value is now up to $970. Bond payable will not change, will it? So I'm going to fill that in right now. It's December 31st. What do we do on December 31st? We sent you another interest check, didn't we? So I'm going to send you a check for 30 bucks. I'm going to amortize another $10 worth of depreciation. Recognize $40 more in interest expense. And what happened? What had happened to our discount? We amortized another $10. So it started at 40. We've now amortized 20, leaving us 20 to go. Carrying value is up to 980. It's June 30th of next year. Same thing, right? $30 cash. Amortized $10 of discount. Expenses 40 bucks. We amortized another 10 bucks of discount. There is now $10 yet to go. Our carrying value is up to 990. It's December 31st, 2015. We're going to send you another check for 30 bucks. We're going to amortize another $10 worth of discount. That's for a total interest expense of 40 bucks. Our bond payable is still $1,000. I've amortized another $10 worth of discount, leaving me nothing, and my carrying value is up to $1,000. My carrying value is $1,000. I can wipe it out. Bond payable $1,000, cash $1,000, and the bond is gone.